Good afternoon, everyone. Welcome to the Autumn 2021 Budget Update. Lovely to see you all today. I'm very lucky to be joined by the wonderful, the amazing.
Oh, God.
How did you know it was you, Guy? Our lovely
weren't
tax
they?
director, Guy Smith. Hi, Guy.
Hi, Nicky. You okay?
Yeah, I'm really, really well. And everyone's hybrid working today. Well, now, and we are literally hybrid doing this webinar because I'm working from home and Guy is in the office. So we're a hybrid team. Then we also have, as always, to keep us in order so that we don't go too long, we don't get in trouble, and also to make sure that all your questions get acknowledged and answered, is the super great Pete Ames. Hi, Pete.
Hi, Nikki. Hi, Guy. Hello, everybody. Thank you for joining us. Nikki, shall I just quickly do the bit and bobs?
Absolutely, go for it.
Fabulous. So those of you who've been on our webinars before are probably already aware of this, but we like to use the chat function for questions because it defaults to only being visible to myself, Nikki, and Guy, which means you can ask any question you wish, confident that no one else on the webinar is going to see it. So you can ask anything, no matter how you might be nervous about it being out in the open world. So just to check everybody has done that, can I just ask you, scroll your little mouse around, and at the bottom should appear the chat function. And if you can just let me know whether or not you found it by answering this simple question. Have you read about what was in the budget already? Or are you relying on Nikki for the guidance? So yes or no, you've seen the budget already. And while we have those answers coming in, Nikki, back to you.
Super, thank you, Pete. So I'm going to dive straight in. We've got quite a few things to get through. First of all, so even if somebody joins a bit late, don't forget we are recording as always, so you can access the full recording later if you found this so interesting that you need to watch it again, or it just might help you to go to sleep tonight. So first of all, so next slide, first slide please, Pete. Well, it's actually the second slide. I just want to go through the contents of what we're actually going to talk about today.
Indeedy, here we go.
So we are going to discuss various things. First of all, I'm going to be taking you through the overall economics of where we are for the UK. So I'm going to just have a top level overview of GDP, debt and inflation. I'm going to then remind you all where we are with corporation tax. So that's mostly what was announced back in March. Then I'm going to touch upon the mentions that we had regarding research and development. Then I'm going to hand over to my reliable Guy, and he's going to take you through the business rates changes, consultation on online sales tax, that's an interesting one. Then also mention about the various green initiatives. Then back to me, we're going to be discussing the changes on work visas, national living wage, before we're back to Guy for is his favourite one, alcohol duty. He's looking forward to that one. Then to his home of HMRC, and then finally to no longer his home, thank goodness. Then on to capital gains tax. And as always, we're going to leave plenty of time for Q&A. We usually do some Q&A during the session, but also we have a big time at the end. So there's plenty of time. So first of all, so we got our lovely graph from, so next slide, Pete, lovely graph from the Office for Budget Responsibility. Oh, do you know, I'd love to work for that department. It's doing all these graphs all the time. I'd love it. And doing forecasting. Anyway, in another life. Anyway, here we go. You will have seen this if you were in our March budget update. I showed the same graph, but now it's of course updated with the October 2021 forecast. There is a subtle change to the trajectory with the October 21 forecast, and you can see it's actually slightly higher. So that's good news. We're not as bad as we thought it was going to be. Obviously, still nowhere near where they hoped it would be in March 2020, when first knowing about COVID, but it is improving, so that's good news. Then next on to debt. Public sector net borrowing. So you can see the huge peak. Now you will, if you watch the budget live, you would think that everything was all super tickety boo. However, a good reality check is that we are our budget, our borrowing is obviously much higher than the COVID. About 10% higher at the moment, and it's still got a way to go before we get back on track. So slightly puzzling considering all the different spending promises made yesterday. However, what it appears to be is they're going to see, rather than too many tax increases, they're relying upon more growth in order to narrow down the borrowing, and they are projecting that it should come back down, coming back to sort of still higher levels than what we were hoping back in March 2020. So still some big deficits there, but it is starting to get a bit better. But it's still a huge amount. I mean, luckily, we're benefiting from low interest rates. Of course, if the interest rates start going up, that's going to be a major change. And there was a mention in the budget yesterday about every 1% of increase in inflation is a massive increase in net borrowing. I'm trying to remember what the figure was now, but it was like 200 billion. Was it billion? It was a huge number. It was, anyway, it was absolutely huge. So inflation's cool, which nicely goes on to the next slide, inflation. So inflation, now these are scary numbers from a business perspective. We're talking about 4% inflation at the moment. So if you normally do perhaps 3% as a general increase for your staff, when you come to your next increase, you've got to be thinking, well, actually, what am I going to do? Am I going to say, well, actually, we'll do 3%, because lots of people will think, well, I'm still real terms a decrease in salary increase. So but of course, then that all just keeps pushing it up, especially in our area, Thames Valley in London, which is where the majority of our clients are. We've already got pretty high employment levels, so it's naturally pushing up those salaries as it is. So you do have to take into account, what are you going to do about, inevitably your salary costs are going to be higher if you stay as is. So I know lots of businesses are looking at outsourcing, whether it's UK or in other areas so it's cheaper, or whether they go to other places across the globe. There's all sorts of things happening in there. Also, their purchases are going up. I was at one of the clients on Monday. They do steel beams. 100% increase on the cost of that steel, which is huge. That's okay if you get your pricing right and you change your pricing quick enough, but that's a huge increase to have to deal with. So it's a huge increases in inflation, and we're going to have to. It's forecast to get back on track down to the 2%, but we'll have to wait and see what actually happens. Next slide, Pete. Okay, so corporation tax. Sorry, I've got a little bit of an echo. I'm not sure if anyone's else is hearing. I think
it's Guy. Guy, do you mind if I pop you on mute until it's your turn to come in on one of the slides? Is that okay?
Yeah, that's fine.
Super, thank you. Sorry, chaps. So corporation tax. So this hasn't changed much. So you will recall back in March, we had huge changes being announced. So this is just a refresher, because of course, most of this none of this has actually kicked in yet. I'm still dubious about whether it ever will kick in. It's just like to highlight there. This is recorded, so everyone can say I told you so, or I shall lose this recording if it isn't. But I'm still dubious about whether this will ever happen. However, at the moment, we are still having to expect, so when you are planning for your businesses, we are expecting that the rates are going to increase up to 25% from the 1st of April 2023. However, if your net profits are less than 50, they will still stay at 19%. Anywhere between 50,000 and 250, it's going to be tapered. So that's a very confusing thing to forecast. I mean, fine if you've got some super great planning tools and you've got some really good ways to forecast, and great, but overall it's basically upwards there. So for most people, those corporation tax are going to be going up unless they change their mind. So watch this space next year. Next on to R&D. Oh no, sorry. Before the R&D is super deduction. So again, a reminder, this is already announced. So this has kicked in now. Nothing's changed since when it was announced. So none of you will have seen the tax credit yet, but you will have already possibly benefited from it if you bought anything since April, because you'll be getting these great 130% allowances for purchases, which is really, really good. So theoretically to offset those increases in a couple of years' time. What was announced, so was a really good piece of news, was that the current annual investment allowances levels, which is £1 million at the moment, that has been extended to March 23. So that coincides with when currently the super deductions are expiring. So, you know, it's obviously encouraging lots of expenditure wherever you can. Do as much capital expenditure is what the government is promoting by 31st March 2023 to keep stimulating the economy. And hopefully, if you're going to do it anyway, might as well get it done before those super deductions disappear and before the AII potentially decreases, because you never know, might get extended again. Okay, next slide, Pete. So finally, for my section, research and development. So there's said to be some various reforms that are going to be happening. In particular, they're talking about different modern research methods are going to be taken into account when calculating your research and development reliefs. So, and just reminder, any businesses out there that aren't currently claiming R&D, have another look with your accountant or your tax advisor whether there is any part of your business that could potentially benefit from research and development tax relief, because it might not necessarily be about your main product or service. There might be other parts of your business that you're creating new innovations that would qualify for this. So it is always good having a thorough look every couple of years or so. And I say couple of years because you can go back a couple of years on these things. So you don't have to look every year and miss it. You could look at this potentially every couple of years. But the modern research methods, what we're talking about there is data and cloud costs. So they're really looking there to try and change what can be included to make sure that it is relevant to the real innovations that they want to be promoting. The next part, which was announced, that they are getting a bit annoyed about where it's not necessarily being targeted correctly. So what they're doing with redomiciliation, don't say that too quickly, regime, is that they're trying to encourage businesses to relocate to the UK so that they can qualify. There's a consultation that's being published about this. So the full details aren't around yet because there's still the consultation paper to be written. But basically, he's really was talking yesterday, specifically said it in the chamber, about that he wanted to make sure that it was the activity happening in the UK that was going to benefit from this. So I believe next is going over to Guy.
Just got to do the old unmute there.
Yeah, there we are.
Yeah,
Unmuted.
Pete, 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 if you can hear me, I would suggest mute yourself as well. Sometimes we can hear your keyboard. I know that shows that you're being super busy, but just so you know.
Just following from your R&D slide, Nicky, I thought it was quite interesting when the Chancellor he threw those stats in yesterday, where he said of the 48 billion of R&D credit that are being claimed for, only 26 billion had been invested in the UK by companies in the UK. So he said that they were going to look into making sure that more R&D investment happened in the UK, and they're going to do something from April 2023, I think he said, to try and make sure it's more focused in the UK. One of the other issues that he touched on was business rates. He said that the multiplier will be frozen from the 1st of April 2022 to the 31st of March 2023. And he also announced a temporary business relief for businesses like hotels, gyms, bowling alleys, cinemas in 2022-23, whereby they will receive 50% relief up to a cap of 110,000. He also announced 100% improvement relief, which will be introduced in 2023, providing 12 months for eligible improvements. Now, what he was talking about there was about where businesses invest in, where they extend. He quoted the example of the factory that extends its premises, or the hotel that adds extra rooms, or the installation of CCTV or bike sheds. All those sort of things will qualify for improvement relief, which will be introduced in 2023, and then the relief will be provided for 12 months after that. There was also another targeted business-related exemption that he brought up for firms with on-site renewable energy. So those firms which fit solar panels or electric charging points. Again, that's not due to come in until the 1st of April 2023. So these things are a good 12 months off, but they're all coming along. And then the final thing with rates revaluations, he said they're going to revalue the rates every 3 years instead of 5, and the valuation office is going to be given, value agencies going to be given more money to help them do the revaluations more frequently. So if we can go on to the next slide, then we can talk about, this leads us neatly into the online sales tax. This is something the government is talking about, is going to consult on an online sales tax, with any tax generated from it to be used to reduce business rates. Now, we've already had that, they did a consultation not long ago where they said they were proposing a 2% levy on all online orders. That's previously been proposed, but that didn't go down particularly well with the British Retail Consortium, who felt that high street traders with a significant online presence will be effectively caught by it as well. And they didn't like the original proposal, and it hasn't gone ahead. So now the government is coming back again to consult on an online sales tax, and like I say, any tax from that will go towards reducing business rates. So the government are obviously trying to do something to try and help high street traders and protect the high street if they can. So if you go to the next slide, please. Next one will be, hopefully, we'll see green initiatives. There we go. There's been all sorts of talk about green initiatives, and when you read through the budget document, there's loads of money that's being devoted to getting people to use more buses and bikes. There's 35 billion that's going to be invested in the rail network over the next 3 years. There's 62 billion to go towards supporting the transition to electric cars. We've had the consult, they've been talking about trying to get people to change their light bulbs over to energy efficient light bulbs, but of course there's a big price difference there between what a normal light bulb will cost and what an energy efficient light bulb will cost, and they've been looking into that, and they've also been looking at insulation. But when you look through the budget book, there's lots of regional grants for sustainable transport networks and all this sort of thing. So there were lots of things that were targeted at either regions or specific forms of transport in the budget. There were lots and lots of different things that were in there. I thought it was quite funny with the during the budget. I don't know if you saw this, Nicky, on Twitter, when after the event, Rishi Sunak went on Twitter and was poking fun at Ed Miliband, who of course was standing in for Keir Starmer, and Rachel Reeves, to highlight how much money was going into their constituencies to help with green improvements in the local area, and he was having a little dig about that. But it was
a little crass.
Yeah, he was. He was like a point scoring at his lowest level. But anyway, next slide I think is back to Nicky about work visas.
Yeah, indeed. So any of you that have been trying to get work visas when you've been trying to do recruitment, you can see how complicated and expensive it can be. There's 3 new types of visas being introduced. So first one is the scale up visa. Now that is for people that have been offered a job that's over £33,000 in the UK. They have to pass the language efficiency, but the idea is that it should be a fast track visa. It should go through pretty quickly. That's the theory. The next one is the high potential individual visa. Now this one is the visa is for the person rather than the employer applying for it. So these will be people that have got a degree from a top global university, and they are the ones that will get it, and then they can come over and potentially, well, hopefully should get employment. Next one, now this one is not until spring 2022. Now this is specifically for overseas businesses. So this is for where they're trying to either establish a presence in the UK, excuse me, or they're trying to transfer over staff. So this is about trying to encourage more of their business over into the actual UK, and to show that for global businesses it is okay, easy and straightforward to do business here. But as I say, that's not being implemented until spring 22. So we don't know how effective that will be as yet. So next, going into the national living wage. This is a table from HMRC. So for anyone with people with staff members, it's important to always look at to make sure that you are adhering to the regulations for national living wage. So when you are, if you do any deductions from your staff for various things, you need to make sure that you are still making sure that you're compliant. Now, Guy's really good at this stuff. So if you've got a huge amount of staff and you need to have a PAYE audit, do let Guy know, and he or his team can provide this service for you. So this, you can see there's been some fairly significant changes. The headline rate is £9.50. Nice easy one. Some, obviously Labour were arguing, why didn't you just do it 10? Well, fair enough, that is easy to calculate, but let's not too carried away. It's gone to £9.50. For many businesses, it's not going to affect them. I mean, we've had no one under £9.50 anyway, so it's not had any major effect. But for a lot of businesses, particularly perhaps in retail section, leisure, hospitality, etc., they probably have a lot of people on the living wage, and so this is a significant increase to their costs. But do remember that the £9.50 is for people that are 23 and over. There are 4 other sections as well. So 21 to 22-year-olds, it's £9.18, so that's another, you've really got to be sharp on working out when people change age if you are paying them underneath. 18 to 20, £6.83. Under 18, That's really mean, £4.81, and that's also applicable to apprentices at £4.81. So mind you, still massively more than, you know, showing my age, the YTS days when you had £35 a week. So it's still significantly more than that, but you know, then everything else was cheaper then. That's probably when Mars bars were 10p. So let's go on to the next section. So this is just to remind you of whether is it still worthwhile the tax savings from being self-employed to employed. Now, there's been lots of tinkering around with different things, with the different rates, or the different allowances. There's been slight small changes, and also the change in national insurance, which is why it's an October change. Now, you can see though, if you are earning £100,000 you are currently self-employed versus employed, there is still a significant saving of between 7,000 to 8,000. So it's still changed. Now, however, you can see there the director, single director versus employee, that gap is significantly narrowing there. You know, it's gone better again from October 21, but it's significantly narrowing. So that's assuming, you know, a low salary, most money coming in dividends. So do be very, I would just say, do be very careful making any assumptions. Always look at your own particular circumstances, because there are a lot of people that are run their own businesses that don't necessarily pay at that lowest level. They may pay, you know, more of a market rate in their salaries, or some sort of hybrid of the two. So do always look at the comparison calculations for your own circumstances. There may be relevant reasons why you've got the mix, but there also could be some potential tax savings. But there's always never always one answer fits all. So always have a look at your particular circumstances. Many of our clients, we do regular tax forecasts with them, and so that they can make decisions on what sort of salary mix, and particularly why we've got the 100,000, because there's still that big cliff there between 100 to 120,000 when you lose your personal allowance. So we have a lot of clients that, you know, if they're just on the cusp, it just makes sense sometimes keeping them at the 100. And remember, if you are running a limited company, you've got a lot more flexibility on timing as well of when you actually take your dividends and things. Yeah, sorry, what makes sense? Sorry, I've just seen a question of what makes sense. So basically, just so clear, it's how much money you're saving if you are self-employed compared to if you're employed. So it is around £7,000 tax that you're having less. And the same with if you're a single director versus being an employee. Okay, then going on to the next section, and it's over to Guy to talk about alcohol.
I think this was the best news item for me yesterday. This was in the budget, with alcohol duty frozen, and with the launch of a consultation that's going to be open until the 30th of January 2022, where the government are looking at taxing alcohol in proportion to the alcohol by volume. So if you're seeing ABV everywhere, that's what it stands for, the alcohol by volume. They want to reduce the main rates down from 15 to 6. So you, in a nutshell, there's money off beer and wine that's not so strong. But if you like your strong red wine, you'll probably be paying more. If you're drinking Prosecco, you'll be paying less. They've also brought in a small producer relief to try and help the small brewers, you know, make more money in effect, and they're also trying to help the pubs by reducing the duty rates on draft beer and cider. So that rate was being cut by 5%. So the government are basically encouraging people to go to the pub not to buy alcohol to drink at home, but to go out to support the local pub. That was the gist of that cut. So when you see the newspapers and they're quoting you a price for duty in the pub and at home, there is the government is making a duty cut for the alcohol that you consume in a pub. So if we go on to the next slide, when we talk about HMRC, HMRC has been given some more money, 55 million, to tackle tax evasion and avoidance over the last. Well, since the pandemic hit really in March 2020, inspectors have been drafted onto COVID work, giving people advice on web chat or other support action that they're doing. And so the investigations dropped off a cliff. There were hardly any that carried on. HMRC offered pauses to lots of people who are under inquiry and said, you can pause and hang on and we'll come back to you when we're ready. Some clients said, no, we want to carry on, want to get this finished. But on the whole, HMRC didn't open many inquiries and haven't really got back up to full speed yet on the normal inquiries that we saw them do before the pandemic. What HMRC are doing now, which Jim Harrow has said, is that they're using nudge letters, or what HMRC call one-to-many letters, where they will issue the same generic letter, one letter to many different people who HMRC have assessed have the same risk. So, for example, they've been sending out letters about CG, offshore disclosures, all this sort of stuff, where they issue the same letter to lots of people. Sometimes you get a clue in the bottom left-hand corner where it may, if you have a client produce a letter to say, I've had this of HMRC, you might see OTM in the bottom left-hand corner, which will give you a clue that it's one letter that's been issued to many people rather than a specific targeted tax investigation. So, sometimes you get a clue as to the nature of the compliance effort that HMRC are making. They also announced various sanctions to come on tax promoters. These are people who promote tax avoidance schemes. There's an effort. They're going to allow HMRC to freeze promoters' assets so that penalties they are liable for get paid. They're going to deter offshore promoters by introducing a new penalty. They're going to close down companies and partnerships that promote tax avoidance, and they're going to share more information with the public to try and put people off participating in them. These are all things that are coming down the line. On debt management, we've had quite a few queries on debt management. HMRC have got a bit of a strange system going on at the moment. If you owe £350,000 or less, HMRC, if you speak to the large debt team, they will give you 2 years' time to pay without any questions. You will just get it. If, however, you owe more than 350,000, then you actually get less time to pay because HMRC consider the business to be higher risk. So then you get referred upwards for somebody to take a closer look at the position of the company or the partnership they're in debt, and they're giving less time. This is particularly hitting firms in the hospitality industry that have been hit particularly hard and have run up debts with HMRC. And they need longer time to trade out of it to get the money back, but HMRC are giving them less than 2 years. So what we've been trying to do with some of our clients is trying to get them to pay, to reduce the debt down to 350,000 and then get the 2 year time to pay from HMRC to try and help with their cash flow. One of the other things HMRC have been using a lot more, a notice of requirement, where they say, you are a high risk to us, you owe us this money, we want you to pay a security. So the business isn't just faced with the existing debt that they've got. HMRC asks for a financial security on top. Now, the notices of requirement are notoriously difficult to shift for HMRC to withdraw them unless you can demonstrate that HMRC are being unreasonable in their approach. There are a few tactics you can try if you get a notice of requirement, but you have to look at them on a case-by-case basis. There isn't a magic one for them. You have to look at them case by case to win the argument with HMRC to get them removed. But if you can't get a notice of requirement, the penalties and the sanctions associated with those are very grave. So you need to advise your clients very quickly. But hopefully you can get a time to pay agreed with HMRC's debt management team, then it won't get to the point where a notice of requirement has been issued. If we can go on to the next slide, then I think that's still me. This is a happy slide, as Nicky calls it, because it's moved from 30 to 60 days to making a declaration on the residential property, which is helpful. I mean, I think most people were hoping it would go to 90 days rather than 60, but it's better than better going to 60 than nothing, than staying at 30. The 10% business asset disposal relief hasn't changed, so that was good news. And there were no other changes to tax rates announced this time. Whether that remains the same when we have the spring budget in March, I doubt it, because it's an area that the government have been looking at, well, on and off really for about 12, 18 months, haven't they, where they've been thinking about how they can realign CG to try and raise more money. I don't think that's off the table. It's just something that HMRC have, the Treasury haven't made up their minds on yet on what they're going to do. But that was it was good news from the fact that no changes were introduced. There were no changes to the rates, and that, you know, the extra 30 days were given. So that's slide. If you want to go to the next one. I think this one's back to Nicky, because this is about frozen taxes. So I've got a feeling I'm going to be muted again. I'm not taking it personally though.
Yeah, they were going to be letting it go again. It's just basically just a reminder of the things that are frozen, in case you hadn't, you were thinking, oh, what's happened to that? So your income tax personal allowance and the high rate is still frozen right up to April 26th at the moment. So that's going to be that will be kicking in from next April 12,570 and then 5270. Inheritance tax thresholds, still nothing really happening there, you know, and that's, you know, the HMRC have been making a lot of money through inheritance tax uplifts in the last couple of years. Fuel duty, that was a big thing, but, you know, there's no surprise. Ever since we've been doing these updates, they've been freezing fuel duties. That was just oh, what a surprise. That's happening again. Lifetime allowance, it's frozen 1,073,100. We are expecting some more changes to happening with pensions, but we're waiting to see what happens there. Capital gains tax allowance, the allowance, that's the amount that you can get from your capital gain before paying any tax, is 12,300 still. So now just going into the summary basically of what we of myself and Guy's impressions of yesterday. That money tree still not died, it's alive and kicking. He was throwing the money out everywhere yesterday, and it wasn't just the backbenchers, the Conservative backbenchers. He was throwing out, like Guy mentioned earlier, to Ed Miliband's constituencies, all sorts of different constituencies, throwing out lots of money. Seems to be enjoying spending. Things that we do want to be, if you're doing some risk assessments and worrying about what are the things from a global perspective, inflation is a big concern. You know, is it really going to go back to 2%, or is it just going to keep on going up? There's serious concerns there with, you know, the global supply issues, with essentially full employment in a lot of the areas that we deal in. There's talks about potential Chinese finance defaults. So this is some of China's biggest companies that have got huge amounts of debt with multiple well, not just multiple, literally hundreds of different finance lines, and what would happen if they do default. What is that going to happen to the global economy? Is that going to become another big credit crunch, you know, back to the 2008 issue? Is that are we going to have a repeat of that sort of issue? Also, Taiwanese tension. There's lots of things happening, deal trade-offs between the US and China at the moment, arguing about the territory. So, you know, we do if you have anything in those areas, is some cause for concern. The budget was very much pitched as being a post-COVID budget. It was almost as if it, you know, all fine. Yeah, admittedly, The front bench, apart from Rees-Mogg and Teresa Joffrey and one other who I didn't quite recognise who that was, were all wearing masks. And so, you know, and obviously Keir Starmer has got COVID at the moment, so it has not gone away. But they definitely seem to be indicating to a market perspective as it's all post-COVID carry on. So that does sort of seem to indicate that, you know, he's far away from wanting to implement Plan B. If the numbers stay around the same or they do start going down, that Plan B does seem to be further away. My personal analysis of looking at numbers is if the admissions to a hospital start getting to the 1,500 rate again, that's when they will do something, because they will be at critical points in the hospitals. Some people would argue they're already at critical point, but that from looking at the statistics, that to me that looks like the sort of point. At the moment there is sort of the 1,000 people a day going in. That's to do with that are with COVID. So, you know, we haven't forgotten it. It's still out there, however much they want to gaslight that situation. Also, we haven't put it up here, but very little mention of there wasn't any mention of the negativities of Brexit. They wanted to use the alcohol duty as a positive of Brexit. So obviously there's probably a mix of views on that. But there are an increasing amount of reports, including from the Office of Budget Responsibility, that it's not just coronavirus that has affected some of these forecasts, creating these issues, but Brexit has had a massive impact. However, I mean, history will find out how and the statisticians and historians will decide, I'm sure, and frame it of how much is affected, these things, from coronavirus and how much is from Brexit. We did feel like he was almost interviewing to be Prime Minister, because he was just so upbeat, so trying to engage everybody, trying to you know, just try to show that he is a Conservative Chancellor. I attended an additional meeting that he had last night, which Oliver Dowden hosted, the chair of Conservative Party, and it was very much, you know, it almost does feel like, you know, like getting ready for an election, whether it's, you know, an election with Boris at the helm or potentially Rishi, who knows. But he was definitely trying to set out his stall there last night, definitely trying to justify that the things he's doing are in line with traditional Conservative values. I'll let you all decide, make your own decisions about that. But I think we've alluded to several times during this presentation today, we think that they're definitely saving up tax reductions for the next election, particularly if growth does continue growing, so that they can still overall have a large tax pot, but can focus on particular tax deductions. You know, the next general election, it has to be by the 2nd of May 2024. Guy and I were discussing earlier, we've got we could quite easily see it happening in 23 though, and so a lot of those things that are kicking in 23 either could be extended or could be big changes. That's our personal thing. So if you are doing 3 to 5 year budgets, you know, be very careful about your forecasting from a tax perspective 2 to 5 years, because it could change dramatically, you know, positively or negatively, depending on how it goes. But you need to make sure that you're putting in lots of contingencies to cover all eventualities. Okay, so I think we're on to our general question and answer section. Just a reminder of contacts. So if you want to talk to us directly, there's Guy and my emails there, and we're both very active on Twitter, also pretty active on LinkedIn as well. So you can search for us on LinkedIn, but those are our Twitter handles. So questions, Pete, what have we got? Have we got any challenging ones?
Well, let me just
Or
come
are
out of
people
slideshow.
being nice to us today?
Let's have some pictures. So everybody was very pleasant at the start. I think that's been a huge tidal wave of information. We have had one or two questions come through. The first one I think I'm going to fire at Guy. So Guy, if you want to come off mute. But just to say to everybody who is there, if you have got questions, we have plenty of time now to answer them. So please do drop them in. If there's anything you want to know more about, Nicky and Guy are here to answer them for you. With that in mind, Guy, you mentioned in the spring budget capital gains might be looked at again. Somebody asked, what do you think will happen? Obviously you don't know, but how do you think it will go?
I think it will depend on how the economy is going, to be brutally honest. I mean, the projections that the OBR have put out about growth continuing at 6.5% this year, 6% next year, he might not need to raise much more money. There's loads of tax increases in the pipeline. The burden of tax is the highest it's been for years and years and years. It's over 35% now. I think it's up to, yeah, it's gone up to 36% now, which is the highest it's been for years and years. So I don't think he'll put up tax again unless something happens that creates another shock to the system where he needs to raise some more money. He seems more intent on spending than he does on than on raising any more money at the moment. And I don't think I don't think that he will, if the projections are correct that the economy will grow as fast as it's likely to.
Yeah, he does seem to want to be liked, doesn't he? Whereas sometimes you get double acts of prime ministers and chancellors, the chancellor being happy to wield the axe on different things. But he does seem to be liked.
Like you touched on, I think they're now thinking about the next general election. I think that's what they're thinking about. And if the growth projections are right, and the borrowing comes down as it's going to be quite low by 2023, after 2023, the projections by the OBR are that growth virtually plummets down to 1%, which is, nobody will feel that in their pay packet. So the longer the government wait to go to the electorate to be elected to try and win another election, they'll want to do it when people feel that they're better off, that they can feel the benefit of it. And I think they'll be trying to time that right. Now, if you look at the growth projections, you look at when the deficit will be coming down, that points towards 2022 being another collecting the tax in, tinkering around the edges. 2023 budget in the spring, I think that will be the giveaway budget, where he says, look how well we've done, we can now give some tax away, we can unfreeze the frozen tax rates and the pay bands and all this sort of stuff. He will say that in the spring of 2023, and then I think we'll have an election either in the summer of 23 or in the autumn of 23, and I think that's when they'll look to go. And they're bringing the tax changes in now. They're bringing all these incentives in, all the things to try and help businesses now, so hopefully there'll be a benefit in the next 18 months where they can say, right, let's go to the electorate. That's what I think they've got an eye on, to be brutally honest.
So a year of investment ahead, and then a year of preparing to take a chunk out of the business, hopefully when they've made it a maximum opportunity for you to do so. Okay, thank you, Guy. This one is probably going to be best aimed at Nicky, I think. So somebody asked when you were talking about, I think it was the slide where you were talking about what's going to be happening going forwards. Somebody asked, do you think in 2022 the biggest risk is supply chain issues, or are there other economic factors that's essentially the crux? The question was more complicated than that, but I think that's what they were getting at.
Supply chain issues, I think, are the most visible thing, because everyone can see that. They can see empty shelves in the supermarkets, and they can see people queuing up at petrol stations. So I think there will be a continuation of that being at the top of everybody's issue list. However, underlying, inflation is a huge issue. The threat of interest rates going up significantly, that would be a huge shock to people that have got used to having these such low interest rates for such a long time. So there could be, depending on what happens, there could be some much bigger shocks coming in, but you can pretty much guarantee that global supply chain issues, and that is globally, it isn't, there are things that are happening in issues across the world that isn't just to the UK. It's just we've just got our extra little sprinkling of the Brexit issues on top with the global supply chains. But yeah, I would say that is definitely issue. But skill shortages, people shortages, resourcing, those are all huge issues too.
Just Nicky, just thinking that this isn't a specific question now, I'm just thinking of it because obviously we're planning to maybe try and run a webinar in November. Do you think something around the subject of planning for 2022 would be a good subject to go for? So talking about these risks and things. Just a thought.
Are you asking me or the audience?
I'm asking you, but I'm also going to go to the audience. So everybody, if you think that a conversation Nicky led around the things to think about in planning for 2022 would be a good subject, please just pop a 7 in the chat for us, and then we'll take that on board.
It was I think it was about 3 weeks ago, I did do one of our Friday business broadcasts. I did a 2022 budget planning session, which is only a 30-minute thing, so it was a super quick, swift thing, and it was sort of almost an ABC of plannings. But I think everyone does need to be planning properly. So whether we do it in a webinar or if people need help individually, definitely there's a lot of unknowns still for 2022. So it's I'm obviously, as always, happy to do one focused on me. Well, I'm focused on planning.
Wonderful. Well, we've had a few people crop up and say yes, so if we see a few more, that's probably going to settle it for us. Next question is going to come to Guy, I think. And Guy, I've popped you on mute again just to avoid the Nicky echo. Somebody has asked, do you think an opportunity to massively simplify the tax system was missed in this budget? And regardless of the answer, do you think it will ever happen?
So is that a question for me or Guy?
Guy, I think.
Yeah, because I think Guy's
much better. I'm getting really offended of being muted all the time. I feel like I'm doing like a ventriloquist act. I think that there are big changes to the tax system coming up anyway. With making, first of all, with the basis period changes that are going to happen, and then we've got making tax digital coming along not long after that once the basis period changes have been brought in. So I think there are already big changes coming in the tax system, and I'm not quite sure what bigger changes there could be that we haven't already got coming. I mean, the move to making tax digital will be a big change for a lot of businesses that are used to dealing with paper. The way I say, I think there'll be a lot of younger entrepreneurs that are used to doing everything on their phone. They'll be used to doing everything digitally, and making tax digital will be a walk in the park. But if you've got, say, a husband and wife partnership that have been running a hotel or a care home or a pub, and they're used to having all their invoices in a binder, and all their records are all immaculately kept in A4 binders or boxes, it will be a real struggle for those firms who know exactly where everything is in these folders to move towards taking a photograph of a receipt or an invoice and trusting that it goes to the right place in the software, and then it goes to the right place in the end of year accounts. I think there'll be a marked difference between who copes with it better than others. I think there will be groups of people that will need a lot more help with making tax digital than the younger generation that are used to dealing with digital stuff. So I think getting rid of whole taxes, well, yeah, taxes or duties. I mean, I'm not sure which income taxes are going to go, corporation taxes are going to go. The government aren't going to get rid of taxes that raise money. That's the thing. So the ones that they brought in, like the air passenger duty tax, I mean, that seemed a bit strange yesterday when we got COP26 next week, and they say, oh, we're going to reduce air passenger tax duty if you fly from London to Glasgow. I mean, that just seems an incredible thing to be saying when you're trying to express your green credentials. I'm not quite sure which whole taxes could go. I mean, there are a lot of smaller ones like petroleum taxes and those sort of things. It's a good question, but I don't know if there are any that could go at the moment that don't serve something for the government in bringing revenue in.
I would guess, actually, looking forwards 15 years or so, certain taxes like fuel duty and so on, they're going to need replacing, aren't they? Really?
Yeah.
As an income stream.
The government are going to need another all the money that they're not going to get from petrol duty. They're going to need to get from somewhere else.
Yeah. In the same way that they're attacking the online retailers now because they've lost all the business rates and so on.
Yeah. So they'll have to, if anything, rather than get rid of old taxes, I could see that we might end up with a few new ones because they'll be trying to recoup the money that they're going to lose from petrol duty. So it's I don't think the government will try to do anything on that in this parliament, but I think they'll have to in the next one. If they stick by their plans to drive everybody towards electric cars, they'll have to do something about petrol duty in the next parliament if they stick to the date when people have to get rid of their petrol and diesel cars.
Okay.
I would just say as an aside as well, the thing is as well is the viewpoint of what is a simplification. So there's the reverse charge VAT for construction. In some ways, HMRC would probably thought, oh, that's a simplification because it means that some people are brought out of the loop for VAT. However, in reality, for a lot of businesses where they're having to have some in, some out, it just makes everything more confusing. So I don't have as a non-tax professional, as in I'm not a specialist like Guy, I find it's quite depressing that it's not simplified. However, also as a business owner of with a big tax department or a growing tax department, it's actually quite people are going to still need us. However much you put on your clouds, they're still going to need the specialists like Guy because it's still a big mystery out there on some of the different tax areas.
Okay, right. So I think a comprehensive answer. Thank you to both Guy and Nicky. I've got another question. I think this came off the back of your answer to the last one. Somebody's asked, what do you think? What is the trigger to look out for interest rate changes? What are the signs that we'll see leading up to? Obviously, you've got the Bank of England, but I can see them playing their cards close to their chest on that one.
A simple thing to look at would be to look at the voting for the previous one. As the voting gets narrower, more and more even between for and against, that's a good indication. If it's still a unanimous, it's less likely. So that's what I would be looking at is there a change in from quarter to quarter on the voting?
Right. Okay. So I think that's a good answer. Easy to track as well. Guy, we've had another question regarding the tax. It's in the chat rather than me trying it because I'm not quite sure what some of those three-letter acronyms mean. Would you care to take point on that one?
Yes, I will, Pete. Thanks for unmuting me again.
I just like the power, man.
What about something like getting rid of income tax, capital gains tax, or VAT? That's what they stand for. Or making VAT a much higher rate, for example, the way around. I think with those taxes, they hit different groups of people. The more you put up VAT, the more you hit lower income families as a proportion of their income. So if you put VAT up, you disproportionately hit lower paid people. If you target CGT, you tend to hit wealthier people who are disposing of assets, who have the wealth and have invested in assets and dispose of assets. So you hit a different group of people. Theoretically, you hit a different group of people with CGT. With income tax, again, rather than getting rid of it, I think what we're getting at there is moving the tax bands around to try and hit people who can more afford to pay tax than those who can't afford to pay tax. Now, of course, over the last since the David Cameron period, what was that, 2010, the personal allowance has gone up a lot faster than it would have done if it'd just been scaled up for RPI, and has gone up quite rapidly. So that's taken a lot of people out of the tax base altogether because by virtue of the personal allowance going up. So whether they could do something with the IT rate bands as a way of, but if they try to change them, that would make things more complicated. there isn't an easy answer, I'm afraid, to that.
In the same
question.
way that we've kind of been talking about the government, the next government is going to have to deal with the loss of certain tax revenues. Can you see this whole push for equalisation of tax burden, that kind of this, America's got this wealth tax drumbeat that's actually now being far more serious than I've ever seen it be taken. Can you see there being a similar sort of juggling round revolution in the tax to try and move that burden, or do you think it will always be those kind of three core taxes moved around?
I think we'll stick with the same core taxes. I can't see them getting rid of any of them. I just can't. It's a tricky. I mean, it's going to be a tricky one for the next government, whoever it is going to be. The way things are at the moment, you would think that if the Tories play it right, it will be them again, because Labour don't look like they're ready to get into power yet. They don't look like a government in waiting. So if it's this Tories again, they'll follow through with what is their mantra, really, of trying to keep hold on public spending, trying to reduce the tax burden if they can. So if they stick to what their mantra is about reducing the tax burden, then I would be surprised if they bring in more taxes to penalise people. But trying to second guess politicians is like trying to pick Euro Millions numbers, isn't it? It's just hopeless.
Yes. Whoever gets it right is a genius. Okay, I think that is every question we've had. So, Nicky, would you like to round us off with a goodbye?
And he's going to mute me now. You watch.
No, I'm going to, because I'm pretty sure she's going to say something about thank you.
Absolutely. I would just like to thank Guy. It's been lonely here on my own doing this for the last couple of times. So it's great to have Guy joining us. And so thank you very much, Guy, for working on this with me. Hopefully it's been really useful for everyone. As always, welcome your feedback. If there's any extra questions that you want to talk online, just let us know. And thanks for Pete for keeping us on track. We're really nicely on track. We're exactly at 2 o'clock. So just want to say thanks to both you guys, and cheerio from me.
And I'd like to say thank you to all the attendees for listening to us all the way through, and for the questions that have been asked. And hope you've learned something from the webinar.
Absolutely. And if you're watching on YouTube, please like and subscribe so that you can catch up with any of Guy's vlogs and other people's vlogs and business broadcast, and see all the other things that we try and produce for you.